A short squeeze in massive proportion is coming for AMC as well as some other key stocks. Guys, there's a lot of information we're going to talk about here in this video. Oh boy, do we have a good one for you guys today. A massive short squeeze on epic proportions is coming for the stock market, but specifically for stocks with a lot of short interest, like our good old AMC. Let's get into this whole entire situation, break it all down for you guys, what is currently going on. So do me one quick favor, if you guys like these kind of videos, hit that like button and subscribe to the channel. Source your comments, questions, or concerns down below in the comment section. That's all that I ask. It's free 99. It does not cost you a single dollar. Thank you guys for those of you guys that went ahead and did that. Now let's get straight into it. So we reported yesterday that hedge funds suffer $32 billion of outflows in the Q2 data. The only guys that are really doing okay right now are the market makers, and that is because the market makers are taking the opposite sides of trade. So you can get deep with this, but long story short, if you bought a stock, if you bought AMC, you bought something else, someone else is on the opposite side of that trade. If you're losing, somebody else is going to be winning on that position or that singular trade. That's the long story short version of how it works, essentially, right? Now, what's currently going on? The US futures, guys, this is the futures market, right? And it's basically, don't make it too complicated, it's basically exactly how it sounds. People are betting on contracts for the future price of the S&P 500, for commodities, for a lot of different things, but here we're talking about mostly the S&P 500, the NASDAQ, and the Dow, because those are the major indexes. The Russell 2000 as well, you could call that a major index also. And guess what's going on? U.S. equity futures, asset managers, and hedge funds positions. Asset managers and leverage funds were record net short U.S. equity futures last week. And this is from JP Morgan's equity derivatives strategy. And if you guys take a look at this, it is completely into the gutter as of right now. You're well under even 2008 level. So yes, this is great when 2022 has been such a shitty year for a lot of people, right? Hedge funds being net short in this proportion, probably what you would want to do. Makes a lot of sense. The Fed's raising rates, inflation's high, you're looking at a possible recession and economic downturn. Now, at this current level, to be this short on the markets is just flat out ignorance. Because where we currently sit right now is an interesting place, because we've been through a lot of pain. A lot of us started to feel pain in November of 2021 when hedge funds first started to really short the markets into the ground. This would be about right here, image on this image, right? It would be about the top, right? There was not a lot of net short positioning, a record low actually. And then the market started to crash, and it's gotten worse ever since. Now sitting at these levels a year later, and right before we get a Fed pivot. Now, we're not going to get a Fed pivot in the way that some people would expect. The Fed's not going to be cutting rates anytime soon. But what they are going to do is slow down the pace of rate increases. Fed Jerome Powell said that himself at the last Fed meeting, that eventually it will make sense to slow down the pace of rate increases. And as we have reported over the last couple of days about the Bank of Australia surprising the markets. They were supposed to do a 50, 75 basis point rate hike. Along those lines, they came out with a 25 basis point rate hike. They said that we anticipate ongoing rate hikes, but right now is a good time to slow down and give the markets room to breathe. And then we all know what happened in the UK. Pension funds were about to go bust because the bond market, the liquidity basically all but dried up, right? So you guys got that out the way. You guys know what that means, right? You're getting a pivot from the UK. You're getting a pivot from the Bank of Australia. Japan, they haven't even started doing anything as far as even raising interest rates or doing really anything, right? So who's the only one that's raising interest rates super aggressively at a record pace as of right now? It's the United States of America. And you've seen a lot of Fed speakers actually come out over the last couple of days, over the last couple of weeks, call it the last week or two, saying that this would probably be a good time to slow down raising rates. Now, what does that mean? Well, it means they're not going to stop raising rates. They're still going to raise rates, but they're going to do it at a much slower pace. And then you also have the midterms coming around. And let's be honest here, Democrats, they're not in a good position for these midterms. They're just simply not. That's not even political. It's just the truth. Even when normal people that don't like politics or don't like anything to do with our realm, right? Our investing world and currencies and finance and cryptos and stocks, people have 401ks. When they look at their 401ks in 2022, they're not so happy, right? So historically, the midterms tend to be a bullish time, at least after the midterms, to be an equity investor, but also it's very much in line with what the president would want out of midterms, to have the Fed boost the stock market up a little bit before the midterms. Obviously, to get inflation down, but that's not going to play a big role in causing more inflation or getting inflation down in general. So mix those factors together, that America is really the only one that's still raising rates almost 1% every Fed meeting. You've seen other banks, other central banks, stopping essentially raising rates that aggressively. And you got the midterms coming up at a time where hedge funds and asset managers are record net short the US equity markets. That's setting you up for a massive short squeeze. And you know what's funny about this is that the data is starting to support a Fed pivot. It's starting to support it. What'd we see at the last jobs report? Well, we lost about 1 million jobs. There was 1 million less job openings, I should say. That was bullish. That caused the markets to rally over 3%. And we actually got some data today that furthermore supports a Fed slowdown to raising rates. And it says right here, Hurricane Fiona helps to boost U.S. weekly jobless claims. I'm not going to sit here and debate if a hurricane did this or not. I would argue probably not. That's a pretty way to paint the picture, but I wouldn't necessarily say that. Now, it says weekly jobless claims increased 29,000 to 219,000. Continuing jobless claims rose 15,000 to 1.361 million. And get this, announced job cuts jumped 46% to 29,989 in September. And that's basically what you're seeing on the main headline of CNBC is General Electric cutting staff, cutting jobs. Who was it? Peloton slashing 500 jobs. You're starting to see these things happening. GE is laying off 20% of its workforce devoted to onshore wind power, costing hundreds of jobs. You're starting to get signs of what the Fed has been waiting for, right? So in the Fed's perspective, if you keep raising rates and you're so aggressive and you do cause an economic downturn, it's a lot harder to work your way out of that downturn than to just give it a pause for a month. So a lot of economists, a lot of people are saying that the Fed might only raise rates by 25 basis points at their November 2nd meeting. And if that happens, the markets are going to take that as a Fed pivot, and the markets are going to sharply rebound. And a lot of your riskier assets, your risk on assets, such as AMC stock, will perform very, very well. It's literally a fact at this point. If the Fed does slow down raising rates, the markets will absolutely rip. We have been climbing over the past couple of days, ever since we did hit that low on the S&P 500, because of rumors of a Fed pivot. This is what caused this whole move. So the securities, the equities, the AMCs of the stock market that have the highest short interest, the most net short exposure, those are going to be the ones that are your biggest runners. And taking a look at the Ortex data as of right now at 12:58 p.m. on October 6th, AMC stock has 19.18% short interest of free float, which is very, very high. 98.82 million shares that are sold short. Relative to the volume that we have been seeing as of recently, it's been pretty low, around 25 million shares that have been trading hands. That is substantial. If you were to see 20% of that, 10% of that covered in a single day, you would probably see a 20, 30, 40, 50% move in AMC stock. And as of right now, it looks like a very attractive bet in my personal opinion. Now, the free float out on loan is sitting at 35.87%, and the shares out on loan sitting at 184.87 million. Days to cover sitting at 4.42, meaning it's going to take a while for shorts to get out of those positions if they are forced to do so, because there's not as many shares trading hands as of right now, and you do still have 100% share utilization. And if we take a look at the cost to borrow max, that's sitting at 36.23%, cost to borrow average at 26.37%, and cost to borrow minimum at 17.52%. So as far as things go with AMC, I think things are really primed in our benefit here. And keep in mind what I've been saying for really ever now is I do think the MOAS, another short squeeze, would happen end of summer, fall time, really before, call it Christmas, really before like the heart of winter, right? That's my personal opinion, and it looks like we might just get another monstrous short squeeze in that time frame. And a lot of the upside, call it the call options, or even buying shares in a stock like AMC for an example here, but a lot of other stocks, the upside potential profit looks pretty good compared to the potential risk of continuing to drop, because a lot of these stocks are beaten into the ground. And like I said, hedge funds are ultra net short on stocks like AMC. So it looks pretty clear to see as of right now. Obviously, I'm not a fortune teller. Come to your own conclusions here. But every single day this continues on and we get higher weekly jobless claims, we get less job openings, we get more of a reason for the Fed pivot, the more I get bullish on AMC stock here, at least in the shorter term. So guys, that is going to be all for this video. Hope you guys found some value out of this video. If you did, hit the like button, subscribe to the channel, source your comments, questions, or concerns down below in the comment section. If you guys want to come trade with me live in real time, link down below in the description of this video as well. Also, last but certainly not least, get yourself some free stocks with Webull, Moomoo, and Public. Also, link down below in the description of this video. Thank you guys for watching, and I will see you in the next one.